Hey everyone, welcome back to the channel. Today I'm going to revisit something I did about a year ago, and that is how to calculate a company's weighted average cost of capital, or WACC. There have been a few comments lately asking about WACC and how I pick my discount rates. So today I'll walk us through how to calculate the WACC of Alibaba, and then we'll use that in our most recent DCF. So let's jump right into it. I have two templates linked below for you to download. The first one is a template for calculating a company's WACC, and the second is our most recent DCF for Alibaba that we've been working off of. Feel free to download these and follow along, but let's start out in the WACC template and walk through each input and explain where they come from. So starting at the top of this template, the first input we need is the market value of equity. We're going to pull this number from Yahoo Finance, and it is just the current market cap of the company. Next is the market value of debt. This one's a bit trickier to get, but it's going to come from the company's annual filing. For Alibaba, this is their most recent 20F. You have to do some scrolling to find it usually, but they'll almost always have a table somewhere outlining their debt and the corresponding interest rates. Here is Alibaba's, and I copied this over into the debt schedule tab. The one thing to note for Alibaba is these numbers for the current principal are actually in RMB, so I have to convert those to USD using the exchange rate of 6.38 RMB per 1 USD. So on my debt schedule, I'm calculating what their current weighted average interest rate is, which is what we're going to end up using on our WACC template tab. For Alibaba, this comes out to 3.57%. The next item to calculate is the cost of equity. To use this, we're going to use the capital asset pricing model, or CAPM. This is laid out based off the three inputs actually right below the WACC calculation. We need the current 10-year treasury yield, which is 2.7%, and we can see this on treasury.gov. Next, we need the expected rate return of the market. I use the historical average return of the S&P. This number should probably be somewhere between 7 and 11%, and you could sensitize this and see how it impacts your WACC in a model. The last item we'll need is the company's beta. You can pull this off of Yahoo Finance, but you may run into issues from time to time if a company hasn't been public for 5 years. Yahoo Finance actually won't provide this. So let me quickly show you how to calculate this. The first thing we need to do is navigate over to Yahoo Finance and go to the Alibaba page. We're going to go ahead and click on the historical data tab. And from here, we're going to adjust the settings to show data for the last 5 years on a monthly basis. Go ahead and hit apply, then download. This will produce a spreadsheet, and we're going to copy over the date range and the adjusted closing price into our beta template. I have this in the WACC spreadsheet, and now what we're going to do is this exact same thing for SPY, which is going to represent the total market. Once this data has been pasted into my file, it'll calculate the beta, which basically represents how much Alibaba stock fluctuates compared to the total market. A beta of 1 would mean the underlying stock moves perfectly in sync with the market. Anything below 1 means it's less volatile than the market, and anything above 1 means it's more volatile than the market. If you come across a company that doesn't have 5 years of market data, you could do a weekly poll for 3 years or some other range. You just need to make sure that you have a good amount of data that you're working off of when calculating it. Too few points, and it's just not a good representation of how the stock actually relates to the market, and too many can sometimes actually distort it as well. If you go back 10 years, a company could be performing differently a decade ago than they do today. So try to keep within 5 years as a best practice, but sometimes you don't have that much data. So now that we have our beta template filled out, we'll calculate the cost of equity using the capital asset pricing model. So just plug this back in, and it's going to spit out a rate for us. And then the last thing we need is the corporate tax rate for our WACC calculation. And we use 25%, which is what is online for China. And this gives us a WACC of 7.2. However, if you plug this into our DCF, you're actually going to get a valuation between 1.4 and 1.5 trillion. Considering Baba trades at 260 billion currently, this would imply Baba is a steal and incredibly undervalued. When we use a more appropriate discount rate, around 15%, we get a valuation around 400 billion, which is much more realistic in my opinion. So why is there such a large difference? Well, WACC can't possibly capture political risk or a lot of other factors. There's just a lot of risk that's not represented through the stock volatility or the cost of capital. So, I mean, Alibaba is a pretty big and safe company. If you're an institutional lender, there isn't much to worry about, and you're probably gonna get paid back. So you don't see a large cost of debt there. You're going to see lower rates like you would on a US firm. And on the equity front, the market understands there's a lot of political risk, which keeps the stock price lower than US peers. But at the same time, the stock isn't overly volatile year round because of the risk, so you don't get a super high cost of equity either. This leads to a lower WACC when you have these formulas. I have another video about why I hate WACC, which I'll link, but it's good to understand as WACC does pop up a lot as you start to get into investing. But I always think it's best the discount rate is more based on intuition rather than a formula. Buffett actually has a great quote on this, on how he decides his discount rate. In a world of 7% long-term bond rates, we'd certainly want to think we are discounting the after-tax stream of cash at a rate of at least 10%. But that'll depend on the certainty that we feel about the business. The more certain we feel about the business, the closer we're willing to play. So really it's a gut feeling and how much risk you think there is in the underlying business. Trying to use a formula will only lead to a overvaluation currently, as interest rates are near zero and the cost of debt is at historic lows, which will artificially reduce your cost of debt and the risk-free rate, which will actually lower your cost of equity. I know this was a pretty quick overview of how to calculate WACC, so please leave any questions below and I'll try to get back to you. As always, thanks for tuning in, and please like and subscribe.